Over the last few months, global markets have started sending mixed signals. Stock indexes remain elevated, yet commodity prices are cooling. Manufacturing data is weakening, even as inflation remains stubborn. And investors are quietly asking the same question: where is global growth coming from now? For years, the answer was simple: China. Whenever the global economy slowed, China stepped in, with stimulus, credit expansion, and massive investment. That is no longer happening. Instead, China is taking a very different approach, one that prioritizes control over growth, stability over speed, and long-term political objectives over short-term market confidence. And that shift is rippling through global markets in ways most investors are only beginning to notice. Today, we're going to break down what China's current economic strategy actually looks like, why it's unsettling global markets, and why this matters even if you don't invest in China directly. China is no longer chasing growth at any cost. For most of the past 3 decades, China's economic playbook was remarkably consistent. When growth slowed, Beijing intervened. Credit was expanded. Infrastructure projects multiplied. Property development accelerated. The objective was clear: keep the economy growing fast enough to absorb labor, maintain social stability, and reinforce political legitimacy. Efficiency was secondary. Debt was a tool, not a concern. That model delivered results, but it also created deep structural distortions. By the late 2010s, the costs were becoming impossible to ignore. Local governments were drowning in off-balance sheet debt. Property developers relied on perpetual refinancing. State banks carried rising credit risk. Growth looked strong on the surface, but it was increasingly debt-driven rather than productivity-driven. At that point, Beijing faced a strategic choice: continue stimulating and accept rising financial fragility, or slow the economy deliberately and regain control. It chose control. What's happening now is not a normal slowdown. China is intentionally stepping away from growth at all costs. Policymakers are prioritizing financial discipline, risk containment, political and social stability. This means tolerating slower growth, even if it disappoints markets. Unlike in the past, there is no rush to reassure investors. Stability inside the system matters more than confidence outside it. That alone represents a fundamental change. Global markets are conditioned to expect Chinese stimulus. Every slowdown over the past 20 years was followed by expansionary policy. Investors assumed this time would be no different. When stimulus didn't arrive, confusion set in, not panic, uncertainty. And uncertainty is what shakes markets. No sector better illustrates China's new strategy than property. Real estate was not just a growth driver. It was the growth driver. At its peak, China's property sector supported local government finances, stored household wealth, drove demand for steel, cement, and energy, anchored construction employment. When indirect effects are included, property accounted for up to 30% of economic activity. That made it powerful. It also made it dangerous. Rather than rescue developers outright, Beijing chose controlled deleveraging. Credit access was restricted. Leverage caps were enforced. Developers were forced to sell assets and slow expansion. Some failed. That was not an accident. It was a signal. The state would no longer guarantee speculative growth. Property weakness doesn't stay inside China. It reduces demand for commodities from Australia and Latin America, machinery from Europe, intermediate goods from Asia. Global markets feel this as slowing momentum, not collapse. And slowing momentum is enough to reprice expectations. China is trying to unwind its property bubble without triggering crisis. That's an extraordinarily difficult task. Progress is uneven. Confidence remains fragile. Household behavior is changing. Even a controlled slowdown removes a major engine of global demand, and markets are struggling to adjust to that reality. China's economic strategy does not rely on openness. It relies on control, and that choice has direct consequences for global capital flows. For most of the 2000s and 2010s, China was a magnet for global capital. Foreign investors tolerated lower transparency, heavy state involvement, political risk, because growth compensated for everything. As long as returns were strong and predictable, capital kept flowing in. That equation has changed. What we're seeing now is not capital flight, it's hesitation. Foreign investors are reducing long-term exposure, demanding higher risk premiums, delaying new commitments. This is not driven by panic, it's driven by uncertainty. China's policy direction is harder to price. Regulatory interventions are unpredictable. Political priorities override market logic, capital controls limit exit flexibility. For global investors, that combination is uncomfortable. And when capital becomes cautious, global liquidity tightens. China was not just a destination for capital, it was a sink for global savings. As that sink weakens, money doesn't simply disappear, it reallocates, often defensively. That shift affects emerging markets. Global bond yields risk appetite across asset classes. Less confidence in China means less risk-taking globally, and that shows up as tighter financial conditions everywhere. China's strategy has another important side effect. With domestic demand weak and investment restrained, excess capacity doesn't vanish. It gets exported. Factories continue operating. Supply chains remain active, but demand at home is insufficient. So prices fall. Chinese firms cut margins aggressively to maintain volume. This pushes deflationary pressure into global markets. Deflation is not just lower prices, it compresses corporate margins, weakens earnings expectations, raises the real value of debt. For global companies, this is painful. For central banks, it's confusing. Central banks outside China are still fighting inflation, but China's strategy pushes prices down in manufactured goods, industrial inputs, consumer electronics. This creates a fragmented inflation environment. Some sectors cool rapidly, others remain sticky. Markets struggle with this kind of inconsistency because it makes policy direction harder to predict. China is no longer pulling global demand higher. It is pushing global prices lower. That is a profound shift. For years, China drove commodity cycles and manufacturing booms. Now, it is intensifying competition and compressing margins. That transition shakes markets, not through crisis, but through pressure. China has slowed before. In fact, every major downturn over the past 2 decades followed a familiar pattern. Growth weakened, markets worried. Beijing responded with stimulus, credit expanded, infrastructure spending surged, confidence returned. That cycle trained global markets to expect one thing above all else: a rescue. That expectation no longer applies. What makes the current slowdown fundamentally different is intent. This time, China is not mismanaging growth. It is choosing to restrain it. The leadership has concluded that excess leverage threatens political stability, property speculation undermines social cohesion, financial risk is a strategic vulnerability. As a result, growth is being sacrificed to regain control. Markets struggle with this because there is no policy signal pointing toward acceleration. There is only acceptance of slower outcomes. Large-scale stimulus would solve short-term problems, but it would recreate long-term ones. Beijing understands this trade-off. Instead of flooding the system with credit, it is targeting support narrowly, avoiding broad-based bailouts, letting inefficient sectors shrink. This prevents crisis, but it also prevents a rebound. The end of the China put. For global markets, this represents the end of the China put, the belief that policymakers would always step in to protect growth. Without that backstop, risk must be priced more carefully. That alone increases volatility. Where the stress appears first, China's strategy will not trigger a dramatic collapse. Its impact will surface gradually and unevenly. The stress shows up first in areas most dependent on Chinese demand and capital flows. Commodities and export economies. Countries that supply raw materials feel the slowdown quickly. Lower demand from China softens commodity prices, pressures government revenues, weakens currencies. This affects emerging markets first, but not exclusively. Manufacturing margins and global trade. As Chinese exporters cut prices, global manufacturers face margin compression. Competition intensifies, profitability declines, investment slows, trade volumes weaken, even without a formal recession. Emerging markets and risk assets. China was a stabilizing force for emerging markets. As that role fades, capital becomes more selective. Financing costs rise, currency volatility increases, risk assets feel the pressure before headline data does. The psychological shift. Perhaps the most important impact is psychological. Markets must adapt to a world where China no longer absorbs excess supply, China no longer guarantees demand, China no longer rescues global growth. The signals that will define this shift. When an economy as large as China changes direction, the consequences don't show up in a single data release. They emerge gradually, through behavior, through capital flows. Through second-order effects, most headlines miss. If China's strategy is truly reshaping the global market, these are the signals that will confirm it. Policy consistency, not announcements. The most important signal isn't what Beijing says. It's what it repeatedly refuses to do. Watch for what doesn't happen. No large-scale stimulus packages, no credit flood to revive property, no aggressive rescue of private developers. Consistency here matters more than rhetoric. If restraint continues, despite slowing growth, it confirms that this is a strategic shift, not a temporary pause. Property stabilization, without recovery. Another key signal is how China's property sector behaves. Stabilization without rebound is the objective. If construction activity remains subdued, prices stop falling but don't rise, developers survive but don't expand, that means Beijing has accepted a smaller, less dominant property sector. That alone changes China's demand profile permanently. Capital controls versus capital confidence. Capital controls can slow outflows. They cannot create confidence. Watch foreign investment trends, FDI flows, portfolio allocations, corporate reinvestment decisions. If capital remains cautious even without panic, it signals a deeper reassessment of China's role in global portfolios. Export volumes and pricing pressure. China's export strategy will reveal a lot. If export volumes stay strong but prices fall, it confirms that China is exporting excess capacity. That deflationary pressure will increasingly show up in manufacturing margins abroad, trade disputes, anti-dumping measures. Markets will feel this before governments respond. Commodity demand versus production. Capacity. China may continue producing, even as demand weakens. Watch commodity imports closely. If production stays high while imports stagnate, it suggests internal inefficiencies are being absorbed domestically rather than resolved. That's a sign of long-term adjustment, not short-term stimulus. Emerging market sensitivity. Emerging markets are the early warning system. They are most exposed to Chinese demand, Chinese capital flows, Chinese pricing behavior. If EM currencies weaken, financing costs rise, and growth diverges sharply, that confirms China's slowdown is being transmitted globally. China's economic strategy is not collapsing. It is recalibrating. But recalibration at this scale is never neutral. For more than 20 years, global markets were built around a single assumption, that China would always prioritize growth and would always step in when the world needed demand. That assumption shaped investment decisions, trade relationships, and risk models across the globe. It is now being dismantled. By choosing control over speed, stability over expansion, and discipline over stimulus, China is fundamentally changing its role in the global economy. Not loudly, not suddenly, but deliberately. And deliberate shifts are often more disruptive than crises, because they remove the safety nets markets never realized they were standing on. This strategy doesn't create a single moment of panic. It creates something more difficult to navigate, a prolonged period of uncertainty. Where growth is weaker, prices are more competitive, capital is more cautious, and volatility is no longer suppressed by policy intervention. The real risk isn't that China's economy fails, it's that the global system has to adjust to a China that no longer functions as the world's automatic stabilizer, a China that no longer guarantees demand, liquidity, or rescue. And in that world, risk must finally be priced honestly. Markets can adapt to almost anything. What they struggle with is the end of assumptions. China is ending one of the biggest assumptions of the past 2 decades, and the adjustment that follows will not be fast. It will not be smooth, but it will redefine how the global economy works for years to come.